Hi again, everyone. I made some adjustments to the board. Notice it doesn't look quite as neat, especially not at the bottom. I can't do the tape because of the way this goes, so it's a little difficult, but I did the best I could. I had a little help from my granddaughter with the numbers. She rewrote some of my numbers, which were kind of illegible, as you can see down here. Not too good. Anyway, this is the second of our two sample statement of cash flows. As I mentioned in the last video, it's like 1635A. This one is very much like the last one we did. It has a requirement 2 and 3, very easy requirement, but it doesn't have any non-cash investing or financing activities like the first one did. And it also doesn't have any sales of long-term plant assets. It has 2 buys but no sells. So because we have no sales, we don't have to look for a gain or loss to either subtracting the gain or adding the loss in the, notice I erased it, I left kind of a obvious space because that's where the gain was in the last problem. We don't have a gain or a loss because we didn't have a sale. So that's good. In this one, we don't have to look at that, but you always have to pay attention if that took place, as I mentioned. So we're going to do it the same way. We're going to start with the net income. Again, this one's on page 893. The top, probably the top 2/3 of the page. 1642B about Robeson educational supply. The net income is $63,600. We always start there. We always add back in as our first adjustment in our operating section, add back depreciation, again a non-cash expense. So we add it in the income statement to get that $63,600 net income. That was one of the expenses that were subtracted. So now we're adding it back in. That's always done. Again, we don't have the gain or loss to worry about because no sales. So we'll go right into analyzing our current assets and current liabilities. Again, we have 4. 2 current assets and 2 current liabilities. Just like always, current assets, the cash, the money moves in the opposite direction. So we have a decrease in accounts receivable. Accounts receivable went down from 21,800 to 14,500. That's a decrease of 7,300. So plus for cash. We look at the next current asset, the merchandise inventory. We have an increase in that. We went from 60,400 to 61,800. That's an increase of $1,400. Notice the negative because, again, opposite direction. Increase in a current asset means a decrease in money, decrease in cash. Now we come to the 2 current liabilities, accounts payable and accrued liabilities, which just means all the rest of the current liabilities. So again, with the current liabilities, it moves in the same direction, the money, as does the change. So we have an increase in accounts payable from 28,100 to 29,600. That's an increase of 1,500, so we have a positive, same direction. And then we have a decrease of accrued liabilities from 11,900 to 10,500, a decrease of 1,400. It's funny, we already had that number. They love to do that in these problems. I think they do it on purpose to be confusing, but they both are a change of 1,400. But we have a decrease in our accrued liabilities, which means a decrease in cash, so that's why we have another negative. Put them all together, the net cash provided by operating, oh, I'm sorry, I didn't get the total yet. 17,400, 7,300, 1,500, subtract the 2 1,400s, 23,400 is the result of those pluses and minuses. We added into the net income that we started with. So our cash provided by operating is just as it should be, a positive number, $87,000. So now we're going to move on to investing, where we didn't actually sell anything. We purchased equipment for cash and we purchased a building for cash. So that caused cash to be paid out. So we have our $54,400. We paid for the equipment and $103,000 for the building, all in cash. So that's going to be a big negative in our investing activities, not necessarily a bad thing. We're getting more of our plant long-term assets, which is very good, must mean business is good, we're expanding. Maybe we're upgrading our equipment and getting a nicer, bigger building or an additional facility. So altogether, the cash used for investing, $157,400. You'll often see a negative in the investing section, and that's actually a good thing. Then we move on to the financing. I erased one because we didn't pay a note in this problem, but we did get one. So cash receipt from common stock sale, and that was $110,000. Oh, 111. I'm sorry. I did write 111. I don't know why I said 110. 111 is correct. And then we got some more cash from issuing a note. We took out a loan, $44,000. I'm assuming we have to pay it. It's not something it's only, we have a payment due this period, so that's why it's in the regular financing activities and not in the non-cash. Sometimes it's difficult to tell the difference. You have to watch it. And then we only had one payment of cash for dividends, $21,200. And that is the first thing, payment of cash dividends. So we're all set to do our cash flows from financing. We have 2 pluses and 1 minus, so this is going to be a big plus. Net cash provided by financing, $133,800, with the 111 and the 44 minus the 21.2. Okay? So put those together, 87,000 minus the 157,400 plus the 133,800. I guess I should have had you rewrite this one too. It looks like very bad next to yours. Anyway, that's a net increase of cash of 63,400. You can check in the book with your cash. 2017, 20,500. The end of 2018, 83,900. Increase, 63,400. Again, you already have the answer before you do the 3 sections. You know what you need to come up with. And then just end it off by proving it out. Your cash balance at the beginning of the year, which is the end of 2017, 20,500, and at the end of the year, I forgot to write that. Oh no, I didn't. It's on the right. I think I have this. I messed up. This is supposed to come down here. This 20,000 is supposed to be 2017, right here like this, and this is 2018. Sorry, I pulled it down too much. I wrote awful big, and when I did it at first, I wrote nice and small. It's easier for me to write small when I do it on the floor. Anyway, this is the cash balance at the end of this current year for them. That's 2018, and the cash balance at the end of last year. So that's it for the statement of cash flows. They ask in requirement to address how they did. Looking at the statement, what can you say about it? Evaluate their cash flows. Mention all 3 categories of each and give you the reason for your evaluation. Well, I only wrote strong cash flow because it is. But what I wanted to elaborate very quickly is investing is very strong because you have the purchases of the new plant assets, as I mentioned, the building and the equipment, which again shows great growth, and they also paid cash for them. I mean, they did borrow some more money, but they used that for probably, it's only 44,000. And look at all the money they paid. And then in the financing section, they sold common stock, which gave them the money to, buy these things that they needed, and also with that smaller note. And they still paid a nice dividend to their shareholders. So all in all, it's good news for them. So the cash flow is very strong in all three sections. The very last requirement is the free cash flow. That's our ratio problem at the end of the chapter. The formula for this is very easy. You take the cash from operating activities, okay? Unfortunately, they didn't come out very good. And that's because you're really not supposed to use, they do in the book, but you're really supposed to use next year's projections for what you think you're going to need for paying for long-term assets. They use the same year, which isn't usually done. I've seen that before in this book. I don't know why they do it that way. But they use the 157,400. You can see already that's a huge negative, because you can only use your cash from operating to see what's free cash flows, what do you have, and then minus the cash dividends of, I forgot my bracket again, 21,200. So they have a negative free cash flow if they based it on what they did this year, okay? But really what you're supposed to do when you do this for real, you're supposed to project for next year's planned payments of dividends or any purchases you have to make for long-term assets or payments on notes that you took out for long-term assets. What they did here is use these exact numbers, and that's not very realistic, but that's all we have to go by, so I had to do it this way. So this is kind of, if you will, the bad news, that they have a terrible negative cash flow. Again, they're kind of mixing an apple and an orange here, so I don't find it too much of a great example of this. The ones that are in the book are much better in the chapter. And there's also another one in the homework, I believe. So that's it for this one. So I think between the two of them, you can get quite the feeling for preparing these. And just let me know if you have any questions. And I'll see you soon. Bye-bye.